I know you've missed me. It's been some time since I've been back to give you a market update. So today I'm going to go over what happened in LA County at the end of 2019 so you can get a full big picture view. And when we sit down together, we can go over courses of action, because now you can see the average and now you know where you are above the average or below the average. And now you can make an informed decision because you are in a position of strength after I go over it with you what happened in November 2019, year over year. All right, so let's get started. And at the end of this, I'm also going to share with you my personal opinion of how realistic these numbers are and how reflective of the market it really is. So with office space, the rent per square feet per year, it's at $40.49. With industrial, it's at $13.29. Retail at $33.18. Remember, these are all per year. And with multifamily, we're at about $1,949 per unit. That's per month, of course. Now, we want to see how's the annual rent growth year over year. I mean, a lot of underwriting, you often see 2% at the very minimum of year over year rent increases. So with office space, we saw 3.2%, industrial 3.9%, retail 1.2%, and multifamily 1.8%. Now, let's look at this. What is the point of having a high rent for your investment if it is vacant all the time? So let's look at the vacancy factor for each of these asset classes, the average for LA County. Office, you have 9.9%, a whopping 9.9%. It's pretty much 10%. Industrial, you have it at the lowest, 2.5%. Retail at 4.6%. And then you have multifamily at 4%. How about when it comes time to sell? Office space, you're looking at $429 per square foot. Industrial, $213 per square foot. Retail, $389 per square foot. And multifamily at $335,000 per unit. So there you have it, a snapshot of how LA County is at the end of November 2019. So now you can see where is like the average and where you are above the average or below the average, and what you can do next to bring yourself to the next level, above average, or maybe move on to another property. So feel free to reach out if you have any questions. And looking at these numbers and based on what I see, this is pretty reflective of the reality. With annual rent growth barely keeping up with inflation, I mean, I've been predicting this for a while now, that everything's just going to go up, keeping up with the pace of inflation and not much more. And this is how the market is going to be, I would say at least for the next 5 years and possibly for the next decade. Cap rate, it's been low cap rates for a while now. LA is still a really popular, hot area, high density. But this is just the average, but in a lot of areas, the cap rate has gone significantly lower, and a lot of people are not taking action. They're trying to wait it out. They're used to higher cap rates, and they're just not accepting reality. But I think after some time, it'll start becoming a norm. And because of the low treasury rates, that's why we're seeing lower cap rates all around everywhere. Vacancy rates, you definitely see this reflected with retail and office being the highest ones. The vacancy rate, you see for lease signs all over the place for office spaces and retail. But right here, you see a little mismatch right here with the annual rent growth and the vacancy rate. And I will say this is because with Class A buildings, you're still seeing good rent growth. It's really the Class C office spaces that are being the ones with high vacancy rates. Class A buildings, they're still doing really well. People still value having a nice office, especially in the service industry, financial industry. You need to have a nice office space. So those are still okay. It's really the ones in tertiary markets that are having trouble with occupancy. So overall, like I said, this is very reflective of reality and what I see. And I hope this was useful for you. Feel free to reach out if you have any questions.